This is one of my favorite real estate wealth building strategies. This method typically requires a little more work than other investing strategies, but you can avoid it in real estate. This strategy and what you put into it represent the pinnacle of cash flow equity and pure real estate dominance. The BRRRR method is another way to invest in real estate that can increase your net worth by a surprising amount. Through strategic leverage, the profit in equity from one property is used to pay for the next property. The profit and equity of that location will fund the next location, which will fund the next location, and so on. After a while, you'll have an army of homes throwing cash at you every month. So let's go over each step of the process and exactly what I do. Welcome to Financial Fluence. In this video, I'll teach you the fastest way to build wealth by investing in real estate. Let's now get going. Number 1. Buy. B for buy. This is revolutionary, but the real deal is to go out and buy a house. And when you buy something, you must purchase something that makes sense. The property must not only have cash flow, but there must also be an opportunity for extra equity, either by purchasing it below market value or by adding equity through strategic renovations. And most deals will not work. What you can get for the property is based on the renovations you make to it. You must also have the patience to wait for a deal that meets your criteria before purchasing it. This is not impossible to accomplish. People do this every day. But you do need to know what you're doing to be able to identify the right property. Number 2. Renovate. The first R is for renovate. The best way to add equity to a property is to spend money on repairs and then profit from the difference between what you paid and what the home is worth afterwards. You've completed the renovations, and in my opinion, this is usually the simplest and best way to increase the value of a property. Most places that need renovation price themselves accordingly, and doing the work yourself is often much cheaper than paying for someone else's already completed work. And by doing so, you make up the difference between what you're in it for and what the property's worth when you're finished. Now comes the really fun part, incorporating your own style, touches, and finishes into the property. Even though I recommend staying fairly neutral, especially if you're doing something to rent out or for someone else, you can still put your own touches and personality on it if you don't like having so much fun renovating a property and just kind of making it your own. For example, you could save a lot of money by installing carpet throughout the entire house. But the downside of being cheap is that you'll end up with less rental income, and carpet will need to be replaced much more frequently than, say, hardwood or laminate. And by doing so, you'll end up earning less money and spending more money over time, replacing the carpet and having done it right from the start. Compare this to laminate flooring, which is more expensive up front. However, you will be able to earn a higher rental income and it will be more durable in the long run. This means it won't need to be replaced as frequently as carpet. In addition, properties with laminate hardwood flooring sell faster than those with carpet. As a result, there is always a delicate balance between the money spent renovating a property and what you can get in return for those renovations. Number 3. Rent. The second R stands for rent. You are more concerned with the long term and the sense of missed opportunity cost, as well as being able to determine what the expected ROI is. It is critical that you consider everything else. Look around the market to see what other places are selling for. This also gives you a good idea of what renovations are common in the area and what you should expect if you've had similar renovations. As for me, I now take pleasure in making minor cosmetic changes. I detest having to pay for issues with the roof, the plumbing, the foundation, or the electrical system. Everything else should ideally already be in good shape, as I prefer to keep things simple. This makes it very easy to replace the floors, remodel the kitchen and bathrooms, and add paint and landscaping. That usually suffices to update it, and it's also fairly easy work. That can be finished in a few weeks or maybe even a month or two by a number of contractors. Most of the time, these relatively small changes to the way the house looks bring in the most rental income. The rental income you receive will show the bank that you have a property that is profitable. The bank is more likely to grant you a loan in that circumstance, and that facilitates the subsequent action. But before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. And let's continue. Number 4. Refinance. The third R stands for refinance. This is where a cash-out refinance is carried out. In this case, a bank will obtain a new loan for you to pay off the old one, appraise your property for more money than you paid for it, and then pay you cash at closing. Assuming you paid $200,000 for a home with a 20% down payment, this means you are now the sole owner of it. Your loan balance has increased from $40,000 to $160,000. Assume you spend $30,000 to improve the property's equity. At this point, your total investment is $70,000. Your down payment of $40,000 plus the $30,000 you spent on renovation equals $70,000. Assume the property is now worth $280,000. If your seam remains intact, the percentage loan on the property, which means you can get a new loan for $280,000 or $224,000. That is, if you do this, you will be able to pay off your previous $160,000 loan while also earning an extra $64,000. The closing proceeds are cash. You've now received $64,000 in remuneration for your $70,000 investment meeting. You now only have $6,000 invested in this cash-flowing property, and you can use the extra. You spend $4,000 to purchase the next property, and you begin the process all over again. Keep this in mind. Many banks have a seasoning period, which basically means that there is a seasoning period between the time you buy the house and the time they give you the new appraised value of the property. Most banks have a 6-month seasoning period. This means you have to wait 6 months from the time you buy the property until you refinance the first loan, which means you can't just go out and buy a house, repair and renovate it, rent it out, and then refinance it 2 months later to do it all over again. You'll have to be patient. It usually takes 6 months to a year, and I can't see myself doing this more than once every 8 to 10 months. Anyway, it takes time to find the right property, renovate it, rent it out, and go through the bank process. Number 5, repeat. The final R stands for repeat. Then you pretty much just repeat the process with the next one. And the advantage here is that every time you buy a property for less than market value, you increase your net worth by the difference between what you paid and what the house is worth. By fixing it up, you also increase your net worth and cash flow. And the higher your net worth and cash flow, the more equity you have in a property. The more likely it is that banks will lend you more money to continue the process. If you have a cash-flowing real estate, you will leave a trail of only cash-flowing real estate behind you every time you do this. Yes, this isn't the simplest strategy. It takes a lot of effort to find and identify a property. It takes a lot of effort to go out and buy it and then renovate it. But this is an entirely worthwhile process. It's also my favorite strategy because when you borrow against properties and use the money to buy something else, you're basically adding to the value of the properties. This is a strategy that can take you far if you put in the initial effort and have the funds for a down payment and renovations. And that, my friends, is an overview of the BRRRR method of real estate investing, as well as the reasons why I adore it. And for summary, BRRRR stands for buy, renovate, rent, refinance, and repeat. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.